daily chart, and we keep testing support, the 20-period moving average, for a while. And we've gone sideways at the 20-period moving average for pretty much the past 5 days almost. And I think the 20-period moving average it's strong. It's influencing the market. We had a strong rally in August for testing support here. I think a lot of traders will see this as an area, a logical area to buy. Not quite 50%, but it's testing pretty much below this bar right here, testing support, the June all-time high, previous June all-time high, testing the July 20th all-time high over here, or July 20th breakout point over here. Traders are hoping that the market's going to stall at the moving average, form a bull bar closing on its high and rally. Now we have a bull bar closing on its high, and that's good for the bulls. That makes me think that there's increased risk that the market is going to try and bounce. Right now, I think two things are going to happen. One, we're going to find support and bounce, or the support's going to fail and we're going to reverse. Right now, it looks like we're going to try and bounce. So I think the bears, they've done enough to make the market a trading range, and this is good, but they haven't done enough to make the market a bear trend. Because of that, it made me think that overall, because of this makes me think overall there's more buyers in this general area than sellers. I'm saying that kind of poorly, but right now, I think ultimately the bears need to do more than what they've done. Ultimately, the bears, they don't mind the bounce as long as we form a lower high, maybe a small head and shoulders top, left shoulder, head, right shoulder. As long as we break to the downside and test back to 7,500, which is the midpoint of this triangle. They want to see a long-term rally here, deep pullback, another rally. They're hopeful this is a final flag. We had a breakout of the final flag. They want the market to go sideways in this area and reverse back down. What would it take for the market to get back down to, I really need to get a new mouse. What would it take for the market to get back down to the July lows, somewhere over here, 7,300? I think we probably need a better top. We probably need a more clear major trend reversal. What I mean by that is we probably need a more clear double top, and we need breakout mode up here, and then a bear breakout testing back down here. But even if we get that, I still think buyers somewhere below, maybe 7,500, maybe 7,400, 7,300, anywhere in there is logical. 5-minute chart, first bar of the day, we formed a relatively large bull bar. There's a couple things wrong with it. One, this bar actually opened on the low of the bar. That's one thing wrong with it. Number two, look where you are. Yesterday's high, yesterday's low is down here, and you're right in the middle of that overall range. And that's generally not the area that's generally a bad location. You don't want to be in the middle of the overall range. And because of that, there's added risk that the market may go sideways. In general, bar one is a better fade than take. And what I mean by that is generally it's better to sell. If bar one's a bull bar, it's better to sell above it. If bar one's a bear bar, it's generally better to buy above it. And a lot of times when you get a strong enough bar, it's pretty common for the market to get some kind of second leg. And because of that, a lot of times what traders will end up doing is they might sell for a scalp, but they're going to wait to see what the first leg up looks like. And then we got a doji on 2. You can see buyers in the bottom third. Unfortunately, I always yawn towards the end of this, so sometimes I have to pause. I just get a sip of water. But whenever we gap down on the open, bar one is a bull bar. So the market's rejecting the gap down. And you can see what happened. We sold off to the bottom third of bar one and found buyers. Now with bar 1 and 2, I think it's reasonable to expect some kind of second leg up. And we got the second leg up on 3. But what do you notice? Bar 1 is a big bar with big risk, overlapped. And bar 2 overlaps a lot of 1. Now you're getting a big bar 3 with a relatively big tail above the bar. And look to the left. Are you clearly in a trend? No, you're in a trading range. So what does that make you think about bar 4? Well, look what happened after bar 1 on bar 2. Bar 4 is probably going to be a bad follow-through bar and probably have a lot of sideways trading. And then bar 4, you can see we rallied, found sellers above, and sold off, closing on its low. bar 4, bear bar closing on its low. That's a good bar for the bears, but I suspect we're probably going to get at least, it's a strong enough bar for the two things. One, bar 4 is a bear bar closing on its low. It's 2 legs up, and it's a strong enough bar that I suspect we'll probably get at least some kind of second leg down. Now, here's the trick. Look to the left. We still have yesterday's high, and this is part of a micro channel. So it's possible that we trigger the sell below bar 4, rally above bar 4, and we rally above yesterday's high. And then we reverse back down. And you can see what happened. The market tried to sell off on 5 and reversed up on bar 6. And the market tried to sell off on bar 5 and ended up reversing up on the same bar. For the bulls, I thought bar 5, it's a strong enough bar that we may go a little bit higher. I think the biggest problem for the bulls is that bar 5 is following bar 4. And there's two major problems. One, I think structurally we're going to retest the open of the day. Typically the market does not form the open of the day is not the low or the high of the day. And therefore I think it's low probability, maybe 70% chance, maybe a little bit less than that, but probably 70% chance at this point that they're going to fall below bar 1. Now we have selling pressure up here. They have a reason for traders to sell below 4 and scale in. And so when I look at bar 5, it's actually logical to sell up here. Maybe you put a stop and measure and move up a bar 5. But from a risk reward standpoint, it's actually quite interesting. You don't have to sell initially. You can wait for a reversal bar. Now we have follow through 5 and 6, but we have a large outside up on 5, or almost outside up on 5, follow through on 6. The follow through bar is smaller. And if 7 is a bear bar or even a pause bar, that could increase the risk to get a second leg down. So some bears selling below 4, scaling in higher. They're not going to sell above this bar. They're not going to sell above this bar. When they get a doji, which is a pause bar, they're going to be willing to sell. And because we're in a trading range, you have to respect the possibility of this being a parabolic wedge. Parabolic rallied on 1, pause 2, rallied on 3, pause 4, rallied on 5 and 6. Now we have a pause on 7, and we may end up getting the reversal down. We still may have to form a more credible top, but if this is going to be a parabolic wedge and reverse down, we should not break strongly to the upside. You can see what happened. 8, we formed a bear bar, closing below its midpoint, but not below bar 5. And then 9, we got the reversal down. So now we have a wedge top, decent bear bar 8, follow through 9. Probably the first reversal up is going to be minor. Some bears, if they're short, instead of getting out below 4, they may hold, taking a chance to see if we get back down to the bar 1 low. And you can see what happens. And we're testing the lows, but that's enough selling pressure. We have an open gap, 8 low, or that 10 high, 8 low. That's good for the bears. And that increases the odds that we're probably going to get some kind of second leg down. And then 11, we have a bear bar, good for the bears. Probably going to go at least a little bit lower. 12, follow through. But now we have a micro channel down, and we're getting near support. Because of that, you look at the bars, bear bar, and then a bigger bar, smaller bar, bigger bar. This is climactic behavior. More tails above bars, less tail, and then equally or less tail, bigger tail below the bar. Makes me think that we may end up bouncing. What are the chances we fall below 1? I think we will fall below 1. The problem is, if you think about a 15-minute chart, one of the problems for the bulls is that we had a strong enough consecutive bull bars here, and now we reversal down. We may get a relatively deep pullback. So the bulls buy up here, they buy up here, which is here. They scale in lower, expecting that we're in a trading range on the higher time frame, and then we'll probably get a bounce. And obviously, that's what happened over the next several bars. 13, doji, not a good sell. Not a great sell. Probably sellers above scaling and higher. And then not a great sell below bars on 13 or 14 either, so we may end up getting a bounce. 15, bull bar. That's good for the bulls. But with all the overlapping bars, I still think the upside's limited. The good thing for the bulls is now we have 3 consecutive bull bars in a 4-bar micro channel. And now you can see what happened. We trigger the sell below 15. Movement outside up, forming buyers. And that's good for the bulls, and it's an increased sign of strength. 17, we have a second leg up, rallied. 14, pulled back. 15, then rallied on 16 and 17. Good for the bulls, but not a great sell below 17, so we may go sideways. And then instead of finding sellers below 17, we found buyers. 18, bull bar closing on its high, and then 19, we broke strongly to the upside. But what do you notice? Buy climax, leg 1, pause, leg 2 to the 17 high, pause to the 18 low, then leg 3. And bar 19 is a climactic bar at the end of a likely rally. This is probably unsustainable, and it's getting really close to the upper third of this area up here. And that makes me think there's probably more traders selling up here rather than buying. And then follow through 20, good for the bulls. And we have a tail on 19 and a tail on 20. So we may end up forming a micro double top. At this point, it's easy to look at this and think, we're getting an endless pullback. But you have to think about it from the standpoint of the bulls. What would you do? What would you do if you ended up buying somewhere up here and you were so disappointed by the rally and now the market's up here? So if you bought here and you scaled in, are you going to look at this and say, wow, I'm going to hold betting on a measured move up? Or are you going to say, oh my gosh, I really do not want to see this kind of a sell-off all the way down here. Maybe I should exit break even, as best as I can on a bounce. And as the market starts to go sideways here, there's going to be less and less traders eager to buy. And that's what ends up causing this 22 strong enough bear bar. I think we'll probably go a little bit lower, but we had a relatively tight bull channel, even though it's a parabolic wedge. It's a leg 1 on a higher time frame. It's just one rally. And so we may get a pullback. We may need an attempt at a second leg up. But 22 is a relatively large bear trend bar. And that makes me concerned that we may end up, and I'm not sure that we're going to immediately rally. You'll have some traders buying below 21, buying below 20, disappointed 22, and they may look to exit on a bounce. And you can see some of them did with the tail, but I still think they're probably sellers in the upper third, and we'll still probably get a second leg down. And then 24, we have a tail above the bar. That's good for the bulls, and it makes me think that there's probably sellers in the upper third of 23, sellers above 23, and we'll still probably get a second leg down. And then because 23 and 24 were not great buy signal bars for the bulls, you had more traders selling at 25, strong bear bar. But what do you notice? Bear breakout 22, disappointment, bear breakout 23 or 25, right in the bottom third of an area where bears got trapped. You had bears selling down here, disappointed. Some will try and get out break even. And that increases the risk that we may reverse up. And then 26, bull bar closing near its high. 2 legs down. That's good for the bulls. I still think the odds are we're probably going to get the bounce. And because of that, I still think the risk for the bulls is that I still think we're going to get a bounce, and we'll probably close the breakout point at 24. So as far as selling above 26, I think it's dangerous. It's 2 legs down in the bottom of a trading range. The one problem I have with the bulls is that we still have the magnet of the bar 1 low, and therefore I think we'll probably end up falling below bar 12. 27, that's a good looking bull bar, but it's rather large relative to the bars to the left. And there's one thought I have with 27. 27 looks really, really good for the bulls. And if 27 is a really good looking bull bar, and there's a lot of energy and buying behind the bar, doesn't that mean that everybody will be wanting to buy at the market on the close of 27? It would. So common logic would tell you, if this is a strong buy and everybody's bailing out of their losing shorts, what is the next bar going to be? It's going to be another really strong bar. And look at 28. And 28 is follow through, and it's good for the bulls. But just think about it for a second. Is 27 really a big bar because everybody's buying, or because all the bears are selling out of their buying back their shorts and bulls are buying, everything they possibly can? Or is 28 really a buy vacuum test of the upper third of this area up here, this rally? Is 28 a buy vacuum test of this, and 29 follow through? If that's the case, that increases the risk that we may have to pull back and go sideways for a few bars. I suspect strong enough rally, buyers below in a second leg up. But again, we have that open in the day, and that's a problem for the bulls. And then I was not expecting 29. 29, relatively a surprise, and that's strong. That's a strong bear bar. That increases the odds. So we're probably going to get some second leg down. Bears will see a sell-off, deep pullback, and they're hopeful this is just a large pullback that'll lead to a second leg down. Follow through 30, good for the bears. I suspect sellers in the upper third and a second leg down. And then we got more follow through 31, 32, 33. Made the low one short, 32 and 33. But when 33 got follow through, and with the magnet open of the day, I thought the odds are we were going to go lower. And then we got the doji 35, but not a great buy signal bar, so we still may go lower. And 36, bear bar closing on its low. You can call it a micro wedge with 31, 34, 36. It's good for the bears, but it's good for the bulls. It's a wedge, but one of the problems is the wedge looks like this. And whenever you get a wedge that looks like this right here, 3 consecutive bear bars, that increases the risk that bulls may get trapped when we break to the downside. And instead of getting a strong bull reversal bar 37, we ended up getting, instead of getting a strong bull reversal bar 37, we ended up getting the tail above the bar. And that increased the risk of sellers above and a second leg down. 38, strong bear bar closing on its low. Probably going to go at least a little bit lower, but look where you are. You're breaking out below strong support. You have a bear breakout and then a channel and another bear breakout. So it's leg 1, pause, leg 2. Plus it's a second leg from this strong sell-off down to bar 12. And because of that, to me, I think 38 has too much risk of being exhaustion. If you're selling 38, what do you do? If 39 is a bull bar closing on its high, you get out. And in this case, it's follow through. 39 follow through bar. That's good for the bears. But look at the follow through bar itself. A relatively big tail above 39 and a tail below 39 with a small body. That makes me think there's increased risk that there's going to be more traders looking to sell. It makes me think there's increased risk that there's going to be more traders selling in the upper third, unwilling to sell closes. Then we tried to rally. We rallied, and instead of breaking strong at the upside, we found sellers above 39, which was expected, and then we sold off. But look at the sell-off. Do you really want to sell the close of 40? Not really. If you think about it, 39 and 40 are probably more trading range bars rather than strong trending bars, even though 39 is a trend bar by definition. You have to think about where the buy and sell zones are in the bar. And because of the overall context, there's probably buyers in the bottom third of 39, and while there's probably sellers in the upper third, and there were sellers in the upper third during 40. But you can see with the market being right here, I think there's going to be disappointed bears who sold the close at 39, disappointed at 40, and they may look to get out break even. You can see what happened. They tried to get out break even on 41, and they couldn't. And then when 42 formed an inside bar, even though it closed below its midpoint, you had a lot of traders buying back their shorts and bulls buying to go with them. 42, that's a strong enough breakout bar, closing on its high. Then I suspect we're probably going to go at least a second leg up. And therefore, you can buy the close of 42. You can wait and buy the breakout point 41. But if the breakout point doesn't get tested and we get follow through 43, you've got to have a plan on how to get in. Then we got follow through on 43. Some bulls will buy the close of 43. Other bulls will set a limit order and buy the close of 42. Let me just see here. 42, 79 and a quarter, and then the low of this bar, 79 even. So if you bought the close of 42 after 43, you would have gotten filled and price went one tick below your trade reversed up. Why does that happen? It's all theory, but the common for me, what makes the most sense and what I always come back to, and the answer works for me, so it's good enough, is 42. A lot of times you can fade breakout bars, and if you're quick to manage, you can avoid a loss. You sell the close of 42, anticipating 43 is not going to be a strong follow-through bar. And instead, what is 43? It's a follow-through bar. So if you sold the close of 42 and you see the follow-through on 43, what are you going to do? It's reasonable. Your premise is no longer valid. You sold the close of a bull bar 42, expecting it to be exhaustion and lead to reversal down. And instead of it being exhaustion, there were more traders actually buying. And you're wrong. You're on the wrong side of the market. Your premise is no longer valid. And what traders will do is they'll look to buy back their shorts at their original entry price. And that makes the 42 close after 43 a logical area of support. And so what are traders going to do if they're flat? Well, if they're flat, it makes sense to buy. And if you're going to buy, why not try and buy at the 42 close, an area that is reasonable for bears to buy back their shorts? And that's what leads to the reversal up 43. Other traders will just be, dumb about it and just say, I'm going to buy it, follow it through, I'm going to buy the close of 43. By the way, when I say dumb about it, I think Forrest Gump kind of dumb. Basically, you don't overthink it and you just say, oh, this looks like it's going higher. I'm going to buy at the market, put a stop down here and hold to see what we get. And it's a really good strategy. 44, we have 3 consecutive bull bars. Good for the bulls, probably going higher. And 45 follow through. And we have a gap, 41 high, 43 low. I still think odds are strong enough rally. I suspect whatever pullback we get will find buyers. We have the magnet of the 16 high. We have the 26 high right here. We have the breakout point, 28 low. That's a logical area. And then ultimately, probably the close of 28. You look back, it was reasonable to buy the close of this bull bar. It was reasonable to buy the low of this bull bar. This is bar 28. And if you did that and you look at the whole day and you think, let's say you did that. Let's say you bought and use a really wide stop. What's wide? You use it a stop, maybe a measured move down of this overall range. You'll exit if you believe the market's forming a bear trend. And you see the sell-off and you think, yeah, that's disappointing. I'll scale in. And you look at this and you think, dang, that's not good, but it's not clearly a trend. And I think the bears need more signs of strength. They got follow through, but you look at that and see that's average follow through, consecutive sell climaxes. This might just be a second leg down from this. I'm going to wait and see what we get. And then once you start to get this kind of behavior, traders start buying and they start selling. The bulls that are long who did not get out start adding to their position. Sometimes they'll buy and they'll just double their position. And, obviously if they did that, they did relatively well. But the point I'm making is whenever you start to see these bars, traders start to get a lot of confidence that we're probably going to try and test back to areas where logical bulls got trapped. And so if you're flat and you're buying what's common logic telling you, you're just probably going to try and test somewhere up here or here. So it makes sense to buy with a target somewhere up there and manage trade appropriately. Climactic bar 46, probably going to go, I still think buyers. And then we got a strong bar 48 or 47, but I still think buyers in the bottom third of the bar. Doji 48, still probably buyers. And then second leg up 49, good for the bulls. But again, really not what you want to see if you're hoping for a sharp reversal down. Bear bar 40, 50, closing on its low. But I still suspect buyers below scaling and lower. And then 51, we have a bull bar. It's a high one buy, probably sellers above initially. But I still think buyers not far below. I made the comment, I talked about these bars. I thought this was a strong enough rally that there's probably buyers below for some kind of second leg up. I don't know what the pullback is going to look like. And then 52, we have a bear bar closing on its low. I suspect that there's probably going to be more traders buying, betting on some kind of second leg up. And then 53, bull bar closing on its high, good for the bulls. And I suspect we're going to go at least a little bit higher. And then 54, bear bar. Can you sell it? Some traders will. But what I talked about is this rally, I think, is strong enough that even if we pull back, there's still going to be buyers below. So always in bulls, they can get out below 54, knowing that it's probably a trap. And there's probably going to be buyers in the bottom third of 53. Follow through 53, 55, good for the bears. But I'd really like to see them fall below strong bull bars. And you see what happened? We failed to fall below 53. So a bull that bought above 53, stopped below 53, ended up making money. And then we ended up falling below 52 during 57. That's good for the bears. But look where you are, 2 legs down, bottom of a trading range. And now, at this point, it was reasonable to expect sellers above in a second leg. Now we have a large bear bar at the moving average and a potential fail breakout below the 53 low. And it's a second leg down. So that's actually bad for the bulls, bad for the bears. And then bulls got a strong reversal up on 58, good for the bulls. I still think it's logical buy, betting on a bounce. And then the bulls, they broke up to the upside and then reversed down on 59. That's, you can call it, can you sell it? I would not. To me, 59 broke pretty far above 58. And even though it's reversing down, it might just be a pullback from the 58 bull reversal bar. And it's right above the moving average in an area that makes sense for the market to find buyers. I don't know if we're going to immediately find buyers, but I do think there's probably buyers not far below. And the bears, they need a series of bear bars closing near their lows to undo the rally. So far, the bulls so far are in control. And then we started to go sideways. Bears who sold below 59 got trapped with 60 and 61. You can see some bears, I didn't mean to do that, but some bears, they sell below 59 at 87 and a quarter. And look right here, the market went to 87 and a quarter. You sell below 59, you look at the entry bar 60 and say, that's not what I wanted. There's not a lot of traders selling. I'm going to buy back my shorts on the test of the 59 low at my entry price. And it touches your entry price and you don't get filled and reverses up. That's a warning that you might be trapped on the wrong side of the market. And the market ultimately ended up breaking out to the upside. Strong enough breakout. We'll probably go at least a little bit higher. And then follow through. Good for the bulls. And I mentioned, I tried to buy the close of 64 after 65, and I didn't get filled here. Then we got the doji, and the market raced up too quickly to the upside at that point, and I missed the trade. It's a clear second leg up after 64 and 65, and it's already a larger second leg up from this, pulling back to this. And at this point, we're just too high in the range. I'm not going to buy up here. And by bar 70, 71, 72, it's too late in the day. Bulls buy the close, bad follow through, 68 expected. And they try and get out, break even somewhere up here. And now, with the market going sideways around bar 72, I think we'll probably try and test the breakout point 66 and probably try and test the low of 65. But again, I suspect the downside is probably limited. And then obviously we tried to sell off, testing the bottom third, and we bounced with 76. And it's pretty much what we got. And then too late in the day for this, but we sold off 77, got bad follow through 78. And what do traders do? They bought. They saw this as a test of support. Give me just 1 second. I'll look at stop orders, limit orders, and answer questions. For limit orders, I mentioned that with bar 1, there's probably buyers in the bottom third of the bar. I thought there were sellers above. I wouldn't buy below bar 4. I think it's a dangerous buy. But I thought there were sellers probably above bar 4 because of the open of the day being basically the low of the day. Remember, this data is wrong on TradeStation. And I would say sellers above, but we never triggered the sell. And I think selling above 13 is really difficult. It's okay, but it's not ideal. And probably buyers below 15. I thought sellers probably in the upper third of this rally. I thought sellers above 23 for second leg down. I thought sellers above 31, and I thought buyers below 41, but never triggered. And really buyers below any of these bars, but they never triggered. That's really common in trading range days, where you just get micro channels that are prolonged that end up reversing. And the reason for that is it's unsustainable behavior. Part of the reason that happens is that it creates climactic bars on higher time frames. Look right here. We have a climactic. We have a bear bar, small bar, big bar. This big bar is climactic. And a lot of traders, when they see it, they'll buy back their shorts. And a lot of bulls, on the sidelines waiting to buy, they're not going to buy that. It's too small. And they expect some kind of second leg. But when they see a relatively big bar, they'll buy it. As they'll expect, think about it. If you're looking for reversal, you want to buy something that is climactic in nature, because if it's climactic, it's more likely to snap back to the average. Like this bar sold off and got pretty big. A lot of traders will buy it expecting that it's going to snap back to average behavior. Anyways, buyers below, and I thought same thing here. I thought buyers below 66, but never triggered. You had bulls that got trapped. They wanted to buy 64. Bulls like me wanted to buy 64 after 65, and they got trapped. And we didn't trigger the pullback, and we just rallied. I thought sellers above 69, but really late in the day, tough to do. And then if you're really aggressive, you could buy the close of 78, but that's just really too late. And I forgot to mention stop orders, but stop orders, bulls can buy above 1. They probably get out below 8 or 9 because of what I talked about on the open. Bulls, if they're bears, can sell, but I think they have to get out somewhere in here, certainly above 16. And then you sell below 21 or 22. I think it's really tough to sell below 22. If you do, you get a second leg down 25, you get out above 26. Bulls can buy, but you still have the magnet of the open of the day. And if you buy it, what do you do when you see 29 start to reverse down? Unfortunately, you just got to get out of the trade. And you certainly get out of the trade below 25 for sure. But when you see a big bar like 29 or 30 follow through, you get out. It's basically a triangle, and you have magnets below. Strong enough leg one, you'll probably get some kind of second leg down, reasonable to get out. And at that point, we had, I don't think you don't buy above any of these bars. So theoretically, the always in bears are still short. I'd get out of shorts above 41, definitely above 42 or during 42. The reason I say 41 is when the market starts to stall, you'll have traders betting that this breakout point is going to get tested and closed. Betting we're going to reach the bar one low, and that's what happened. Bulls can buy 41, they can buy 42, they can buy 43 for any reason. And at this point, you can get out of longs below 50, you can get out of longs below 54, you get out of longs below 59. But I think buyers above 63, buyers above 64, buyers above 65. And other than that, I think that there's going to be, it's probably it for stop orders. And if you're long, you get out below 65, definitely below 72. And that's probably it for stop orders. Buy the close, sell the close. I mean, any of this is great. Buy the close, sell the close. If you understand the context, probably sell the close 9 or 10, betting on a test the open of the day. Out of anything, 19 and 20, or sell the close bars, betting on 3 legs up in the upper third of the range. If anything, 25, tough to do. It's probably more of a buy the close bar, bottom third of the range, possibly forming a triangle. And you end up buying the close 27, 28. Well, if you do, obviously 29, you get trapped and you got to get out. Ideally you reverse short. And then 38, it's technically a sell the close bar, but I think it's a bad context. It's exhaustion and more likely to lead to a pullback or reversal. And because of that, if it's more likely to pull back or reverse, it's usually better just to wait and see what the pullback looks like and then decide if you want to enter, if you want to sell, betting on a pullback, or it's better to wait and see what the pullback looks like before deciding if you want to take the pullback entry. You can buy above 58, stop below 58. You can buy above 63. You can buy above 64. Any of these bars. We're talking about sell the close or buy the close. So buy the close all through here. Thought that was okay. You can probably buy the close 64, buy the close 65 for a bounce, but high in the range, tough to do. And down here, if anything, it's buy the close. That's really difficult. Where do we go tomorrow? I think that tomorrow is, if the bulls are lucky, we'll get strong follow through tomorrow. But we have a lot of overlapping bars, and this bull bar today overlaps a lot of yesterday. So if the bulls are lucky, the Globex session will rally and will gap up and have signs of strong buying pressure. If we gap up and then maybe tomorrow forms a trend, that'd be good for the bulls. But the bulls have a chance here, and I think they need to do something with it. Otherwise, more likely, probably be more sideways here, and maybe we form some sort of weak doji. But bull bar at support, good for the bulls, but 4 or 5 overlapping bars, bad for the bulls. The bears obviously want to prevent the bulls from getting a strong upside breakout, but we'll see. All right. Thanks everyone. And I will talk to everybody tomorrow after Al talks. Okay. Have a good day.